Okay, we are finally ready to start talking about how the numbers get on those financial statements. I know, remember I've told you, we start with the end product and then we find out how we get there. Now, just like with anything you do in life, there are standards to the accounting process. If you play baseball, you know there are rules. If you play hockey, there are rules. Same thing applies in accounting. So let's talk a little bit about these standards and where they come from and their purpose before we get into actually looking at transactions. Generally accepted accounting principles is the set of standards of how we do accounting. There are rules for how we do things, what transactions we enter, how they are entered, when they are entered. And GAAP, as generally accepted accounting principles is known, are those standards. Some of the bodies that help determine the GAAP guidelines are the Securities and Exchange Commission. We often think about that when we're thinking about the stock market. FASB, Financial Accounting Standard Board, that's the primary standard setting body in the United States. And then internationally, we have the International Accounting Standards Board and the Public Accounting Oversight Board. As GAAP falls under FASB, under the International Accounting Standards Board, we have, I call it IFRS, it's the International Financial Reporting Standards. GAAP and IFRS are very similar. The format of the financial statements are slightly different. Hopefully, someday we'll all be on that same page. One can hope. For years now, they have been trying to join the United States standards with the international standards, but just like with metric, the United States just seems to like to do its own thing. That's why I call it IFRS, because I'm beginning to wonder if we're ever going to get there. The book wants to kind of make it seem like that this is a recent occurrence, but we have been working on this for years. And still there is not a date in sight where the United States will conform to international standards. I always will tell you that financial statements need to be accurate, timely, and useful. And that's kind of what this is saying here. According to FASB, our financial statements need to be relevant and have a faithful representation. Relevant, are they useful? Can we use them for something? Can we use them to make decisions in the business, to forecast for the future? They need to be relative. If they're not, they have really no point. And it should be a faithful representation. It's accurate. It actually depicts what happens. Now, I can tell you it's very easy to prepare financial statements that are inaccurate. One, from simply making mistakes, or two, from people trying to be fraudulent. So the information must be complete. It needs to be reviewed and audited. And it needs to be free from error. Other qualities of the information are these. Needs to have comparability. I need to be able to, in some fashion, compare my financial statement with other accounting firms. So in order to do that, we all need to use the same accounting principles. The information needs to be verifiable. Can I prove that the amount in my cash account is correct? Well, yes, I can if I reconcile my cash. Can I prove that the amount in my inventory is correct? Well, yes, I can if I do an inventory, count my inventory. Auditors, other people, can also verify information. Is it understandable? Is it presented in a clear and concise fashion? And I'm laughing as I say this because after the first two chapters, you guys are probably going, no, it's not understandable, but it will be. Is it consistent? Do I use the same accounting methods year after year, or if I change something, I make statements that tell why I have changed it? I can't change my accounting principles every year. And is it timely? It can't be relevant if it's not timely. What good is a financial statement for 2016 if I didn't get it until the end of 2017? It's too late to make changes. Counting time period. Many companies use calendar years, but many companies also use fiscal years. And the corporations can choose a fiscal year, and they generally choose it based on their life cycle of the business, the business cycle. They want to have their year end at their slowest time. Think about a toy store trying to close their books on December 31st when they've just come off of, 3 months of the busiest time of the year. So choosing an appropriate year end is important. I want you to look at the very last sentence in this slide. In the notes to its financial statement, Best Buy states that its accounting year end is the Saturday nearest the end of January. That is the most bizarre year end that I have ever seen. And we have looked at some of their financials in chapters 1 and 2, and I have pointed out the problem with the dates on that. This is an exception. It is not the rule. You need to forget it now. Company year ends end on the last day of the month, whether it be a calendar year or a fiscal year. Sorry. Assumptions that we make in financial reporting. First assumption is the monetary unit. Everything that we put in our books must be able to be quantified. We've got to be able to put a dollar figure to it. It is expressed in money, and it is expressed in the monetary value of the country in which you reside. My accounting software program has the ability to switch currencies, so every once in a while I'll print my financial statements in pesos instead of dollars just for fun. But monetary unit, you only record things that can be expressed in money. An economic entity. We don't mix personal and business. It can be separately, the business can be separately identified. Periodically, that's not the word, I'm not even going to try to say that, states that the life of a business can be divided into artificial time periods, such as quarters, months, and week or year. And the life of the business is from the beginning until it ends, but we break it down into smaller time periods. We also have the assumption that it is a going concern, meaning that the business plans on continuing to be in business next year and the year after. We didn't form a business to sell a product and then close it. That's not a going concern. Going concern means we are going to remain in operation. How do we measure things? Historical cost, also called the cost principle, says that everything we record is recorded at its cost. Fair value or fair market value indicates that assets should be reported at fair value. Now, I will tell you that we will record everything at cost. There are very rare instances, and if you read through the gobbledygook in the book, they make things so difficult and so confusing. If you read through all of that on page 83, at the very end, the very last statement under fair value principle is the statement that applies to this. Only in situations where assets are actively traded is the fair value principle applied. It is not applied in any other instance of asset or liability. And there are very particular ways in which you do that, which are way beyond what we're learning in this class. So fair value has really no application in what we're doing. Full disclosure principle, you tell everything that's meaningful about the business. If you remember when we were looking at the annual report, there was a section of notes there where you state if there are things going on that could make a difference to people who are financially involved with the business. As we go through the book, we're going to learn about many things that companies should do or that it's suggested that they do. This is where the cost constraint comes into play. It's a cost-benefit analysis. If I implement this particular thing, is the benefit I'm going to gain from it worth the cost? Now, we'll talk about in further chapters handling money, and you have one person that would take the money, another person that would do the deposit, and another person that would reconcile the bank account, so that you've got many people overlooking that, and the chance of fraud is very slim. Well, in my company, I have 4 people. It's not advantageous for me to hire 3 people just to handle the cash. So I have to weigh the cost against the benefit. All right, finally, we're getting there. What is an accounting transaction? An accounting transaction is one that you can put a dollar value to and that has an impact on the books or the accounting equation. If I go to Staples and buy office supplies, that's going to impact my books because it's going to reduce my bank account and increase my supplies. Oh, wow. Did you just hear that? Going to Staples affected 2 things. That's this dual effect on the accounting equation. Every transaction that we have will affect at least 2 things, possibly more. Are the following events recorded in the accounting records? I purchased a computer. Yes, it affects the accounting equation. I discussed a trip. No, there's no impact. I pay the rent. Yes. I hire an employee. Well, yes. Oh, maybe no. I don't know. Hiring the employee does not impact the books. When I pay the employee the first time, yes, that is a transaction that will be recorded in my records. So we have to think through the things that we're doing. Are you ready? Basic accounting equation. We've talked about this. This is nothing new. Assets equals liabilities plus stockholders' equity. Assets are things you own. Liabilities are things you owe. Stockholders' equity is the combination of stock, retained earnings, which all come together to make this equation balance. Now, if you remember, I expanded the accounting equation for you, and here is an example of an expansion. Stockholders' equity is made up of stock. It's also made up of retained earnings. It's also made up of retained earnings, which in turn is made up of revenue minus expenses, and dividends are also deducted from retained earnings. Now, if you remember, revenue minus expenses equals net profit, which is brought over to the statement of retained earnings. Dividends are what we pay stockholders or the owners of the company when we give them a portion of the profit. I like my expansion of the accounting equation better, but that's just me. All right. We have a transaction. On October 1st, cash is invested in Sierra Corporation by investors in exchange for $10,000 worth of stock. Now, what I would like you to do is look at page maybe 87 in your book. We're going to be doing our work on a spreadsheet. And that spreadsheet is broken down into the accounting equation. So as we record items, we will see on the spreadsheet how it affects the accounting equation. Also, we have listed under assets, remember I was talking about account names, liabilities, there's account names. So we're going to do our work on a spreadsheet. This is not how you would do the work if you were in a true accounting course. But you don't need to learn general ledger and general journal and debits and credits and ledgers and all that sort of stuff. You just need to know where the numbers are coming from so that you can properly analyze the financial statements, so you can know the underlying information. How many times have I told you so far? A number is simply a number unless you know the story behind it. So this is how we're going to learn that story. So on our spreadsheet, we received cash, so that's going to increase our cash. And we got the cash because people bought stock. So our spreadsheet will look like this. Cash is increased and our stock is increased. Well, they're both pluses. How does that work? Shouldn't one be a minus? No, because we have, you want to look at your accounting equation, we have 10,000 of assets and we have 10,000 on this side, liability and stockholders' equity. So it balances. That's what we're always looking for. Does it balance? Sierra borrowed $5,000 from the bank by signing a 3-month, 12% $5,000 note payable. I think we talked in a previous chapter how a note payable is different from an accounts payable. A notes payable is a formal promissory note that generally has interest attached to it. It has a time when it is due, and it is signed. So if we borrowed money, we're going to increase our cash, and we're going to increase a notes payable like this. Now, our assets are now $15,000, and on this side of the accounting equation, we have $15,000. So we're good. We're still in balance. Sierra then purchased equipment by paying $5,000 cash to Superior Equipment Sales. Buying equipment. This is not something we're selling in the business, but something we are using to do business. So it becomes an asset, and our cash is reduced. Now I want you to look at this. Both entries were on the asset side of the equation. We decreased our cash and increased our equipment. We still have $15,000 in assets and $15,000 on this side of the accounting equation. You follow that? Each entry before, one entry has been on one side of the equation and the other entry on the other. This one, they're both on the asset side. Sierra received $1,200 cash advance from R. Knox, a client. Oh, we haven't talked about this. Cash advance. Sometimes when clients come into my office with a large job, I will ask them to pay a retainer up front. Now, when they pay me that retainer, that money is not yet any type of revenue because I have not earned it yet. Stop and think about that for a moment. I want you to notice this column that says unearned service revenue. And it's a liability, which generally means we owe somebody something. Well, if somebody gives me money as a retainer, and then I do not do the work, I owe them that money back. So until the work is completed, that money is a liability. So this $1,200 is going to increase our cash, but it's also going to increase our liabilities until the time that the job is complete and I can move this money from unearned to earned revenue. A lot of concepts to throw in there, huh? All right, they got $10,000 in cash for guides services performed. Well, there's my cash. Oh, there's my revenue. Okay, so I'm going to increase my cash, and I'm increasing my revenue. And we want to note that this is service revenue. Remember, all the things that go on the income statement are going to be here under this retained earnings. So we paid our office rent for the month, so we decreased our cash and decreased our retained earnings. Income increases retained earnings. Expenses decreases retained earnings. And we paid $600 for a one-year insurance policy that will expire next September 30. Now let's stop and think about this. We talked about prepaids last chapter, I believe. If I pay for something for the future, it is not yet an expense. So we set it up as prepaid because until I use it up, that company would owe me the money back. It's like unearned revenue, except the reverse. So I would decrease my cash and increase my prepaid insurance because I am paying ahead of time. And we purchased 3 months of supplies on account. Now, this is interesting. We purchased our supplies. We haven't used them up yet, so they're still an asset, but we didn't pay for them. We purchased them on account. meaning that we're going to pay for them in the future. That becomes an accounts payable. Accounts payable are generally due in the next 30 to 45 days, but we go ahead and enter our asset and say that we have this liability we're going to have to pay soon. Then we hired 4 new employees to start work on the 15th. What do I do with that? I don't do anything except send them to HR and let them fill out their paperwork. Until I actually create a paycheck for them, there is nothing in the accounting records that I need to take care of. And then we paid a dividend. Okay, we reduced our cash and we reduced retained earnings. So I want you to glance over this and see how we handled all of our transactions for the month. The next thing we need to do, whoops, I'm sorry, I missed one there. Employees have worked 2 weeks. Total earnings for all of them is $4,000, and that was paid on October 26th. So we need to reduce our cash and reduce our retained earnings. The next thing we need to do is total our columns and make sure once again that our accounting equation is still in balance. And here we have 23.3 in assets, and we have 23.3 in liabilities plus stockholder equity. So our accounting equation is still in balance. Now I need you to remember that simply being in balance doesn't mean it's correct. But at least we know we've entered pluses and minuses correctly. And that should not be the end of that chapter. If you follow along in the book for a moment, after we summarize our transactions, the book starts talking about preparing financial statements and asks you to compare the statements on page 92 with statements for the same company that are in chapter 1, but then tells you that the statements are different. So I want to just talk about that for a moment. What we have completed here are the basic transactions for the month. But before we prepare financial statements, we need to look at these transactions and see if there's anything further that we need to do. When we get to chapter 4, we're going to learn about adjustments. Well, let's just think here a minute. Okay, here I have unearned revenue. I would want to look at that and see if I've earned any of that revenue before I prepare a financial statement. Here we have prepaid insurance. I would want to look at that and see if some of that has now been used up. This was a year policy, so I'm assuming 1 month of that, or $50, should now be an insurance expense. Supplies. I probably don't still have $2,500 worth of supplies on hand, so I'll need to make an adjustment. We'll learn about doing that in the next chapter, but what I want to bring your attention to is if we're going to prepare financial statements that are timely, usable, and accurate, we don't want to prepare a financial from this information because this is not accurate yet. There is more work to be done. So I'd like you to take your time, go back through, look at transactions, and practice with some of the things that are in the chapter for you so that you can get used to handling transactions. Now, some of those problems will have you go ahead and prepare financial statements, but know that those would be considered unadjusted financials and be prepared merely for you to have the chance to look at them to see what else needs done. And with that, we are finished with this chapter. Thank you very much.